Okay, let's unpack this. Welcome to the deep dive. Today we're diving deep into the powerful currents that shape our financial world. We're talking about economic factors, financial markets, and how they influence, well, everything, from your investments right down to the price of groceries. Our mission to cut through the noise, reveal those crucial connections and help you understand how these big trends directly impact your everyday financial decisions. We've pulled together a really rich set of sources to guide us.
It's true, and
Yeah.
these aren't just like abstract concepts for economists sitting in ivory towers. What's truly fascinating, I think, is seeing how things like inflation or interest rates, they directly hit your wallet. Whether you're managing investments or just, budgeting for the week, being well informed isn't just for the Wall Street pros, it's really about confidently navigating your own economic landscape.
Absolutely. So let's start with the very pulse of the economy, because its performance is basically the foundation for everything else. For investors, there's this constant balancing act. Are we heading into a slowdown, maybe a recession, which might cool demand for stocks? Or is it inflation rising prices that's going to eat away at the value of our returns? It's a dynamic tension, isn't it?
It really is. And to gauge that pulse, yeah, we often look at national output. Most people have heard of GDP, gross domestic product. That's the total value of all goods and services produced within the country's borders. Doesn't matter who produced them.
Mm.
So, that Toyota plant in Ohio, those cars count towards U.S. GDP. It replaced GNP as the main measure for a good reason. It tells us what's happening right here on the ground.
Right. And what's really crucial, like you said, is we rarely just look at that raw number. We focus on real GDP, GDP adjusted to inflation. Why? Well, because if GDP goes up 5%, but inflation is 3%, your actual growth is really only 2%.
Exactly. It strips out the price increases.
So it's the primary indicator for true economic activity. Tells you if the economy is actually expanding, not just, puffing up with higher prices.
Precisely. And that link between rising GDP and potential inflation, that's really critical because inflation itself can have such huge effects.
Oh, yeah. It's that buzzword we hear constantly, inflation. At its simplest, it's just a persistent rise in the overall price level. Your money buys less than it used to.
The classic definition is too much money chasing too few goods. Basically, demand is outpacing supply, pushing prices up.
Like trying to buy a house in a super hot market. Right. That's inflation in action on a smaller scale.
And the main way we track this is the Consumer Price Index, the CPI. It measures a fixed basket of goods and services, things typical consumers buy. Rent, groceries, gas, you name it. If the cost of that whole basket keeps going up month after month, well, that's inflation hitting your budget.
And the ripple effects. They can be pretty widespread. Inflation often goes hand in hand with rising interest rates, and that can really impact certain types of companies. Think about utility companies.
Oh, definitely. They often carry a lot of debt, right, for building power plants, grids, all that infrastructure. So when interest rates rise, their borrowing costs go up. That squeezes their earnings.
Which can push their stock prices down. Yeah, financial services companies feel it too.
Okay, so if inflation is always a potential threat, how do investors try to protect themselves? What are the typical hedges?
Well, historically, equities, stocks, and things like stock mutual funds or ETFs have actually done pretty well. Company earnings and asset values tend to rise along with general prices over the long term.
And what about other things, like commodities?
Yeah, commodities are another classic hedge.
Yeah.
Gold and silver, especially, tend to hold their value or even rise when the purchasing power of, say, the dollar is falling. You can invest directly or through futures, ETFs. Lots of ways.
Now, fixed income bonds, that seems trickier.
It is trickier. Bond investors face like a double whammy with inflation. First, if interest rates rise to combat inflation, which they often do, the market value of existing bonds with lower fixed rates, those prices fall. Right, because new bonds are being issued at higher rates.
Exactly. And second, the fixed interest payments you do receive buy less and less over time because of inflation eroding purchasing power.
That's where that concept of the real interest rate comes in. It's super important.
Crucial.
It's not just the interest rate printed on the bond, the nominal yield. It's what you actually earn after inflation takes its bite. So the formula is basically bond yield minus the inflation rate. If your bond pays 5%, but inflation is running at 2%,
Your real return is only 3%. That inflation eats into it.
which is why when inflation expectations are high, bond investors demand higher yields up front.
Or they shift strategies. Maybe shorten the maturity of the bonds they hold, or buy things like TIPS, Treasury, inflation-protected securities, where the principal adjusts with the CPI.
Makes sense. And just quickly, while we're here, the opposite of inflation is deflation, right? falling prices.
Yeah, a persistent and significant decline in prices usually happens in severe recessions when demand collapses.
And that's different from disinflation.
Right. Disinflation isn't falling prices, it's just inflation slowing down.
Right.
So prices are still rising, just not as fast as they were before. Maybe inflation drops from 5% to 2%. That's disinflation.
Okay, got it. Now, here's where it gets, I think, really fascinating. The economy doesn't just move in a straight line. It has these cycles.
The business cycle, yeah, these recurring ups and downs in economic activity.
And it typically has four main phases. First up is expansion or recovery. Things are looking up. Economic activity increases, production ramps up, demand grows, companies start hiring again.
And interest rates usually start to tick up too because businesses and consumers are borrowing more.
Yeah.
Activity fuels borrowing.
Then you eventually hit the peak. This is the top of the cycle. Demand might even outstrip supply here. Prices rise, hello, inflation again, and maybe consumer purchasing power starts to get pinched.
Then comes the turn, contraction, or what we usually call recession. Demand weakens, factories slow down, companies might start layoffs, unemployment rises.
And inflation typically slows down. That's disinflation again. If it gets really bad and prices actually fall, that's when you hit deflation territory.
Right. And then finally, you reach the trough. That's the bottom, the lowest point. Unemployment might be high, activity is low, but eventually those lower prices can stimulate new demand, businesses see opportunities, and the whole thing starts over with a new expansion.
And just to put a definition on it, a recession is technically, what, 2 consecutive quarters of falling real GDP.
That's the common rule of thumb, yeah. A decline in real GDP for 6 months straight. And a depression is just a much deeper, much longer version of that, much more severe.
Okay. So economists and investors, they're always trying to figure out where we are in this cycle and where we're heading next. How do they do that?
They use business cycle indicators, data points that tend to move in relation to the economy. They fall into 3 broad categories.
Leading, coincident, and lagging.
Exactly. Leading indicators try to predict the future. They change before the overall economy shifts direction. Think about things like new orders for manufacturing goods or building permits for new houses. If those start falling, it might signal a slowdown ahead.
Even the stock market, like the S&P 500, is considered a leading indicator, right?
It is, yeah, because markets try to anticipate future economic conditions and profits. Consumer expectations are another one.
Okay, then coincident indicators.
Those move pretty much in sync with the economy. They tell you what's happening right now. Examples would be current employment levels like non-farm payrolls or industrial production. They reflect the current state of activity.
And finally, lagging indicators. These change after the economy has already shifted.
Right. They kind of confirm what's already happened. Things like the average length of time someone stays unemployed or the average prime rate charged by banks. They tend to bottom out or peak after the economy does.
So bringing this back to you, the listener, understanding these cycles and indicators is pretty key for investing, isn't it?
Absolutely. Bond markets, stock markets, they react differently depending on the phase of the cycle. Investors are constantly watching these indicators, trying to anticipate shifts and adjust their portfolios accordingly. It's about trying to stay ahead of the curve.
And one huge factor influenced by all this is interest rates. We keep coming back to them.
Because they're so central.
Yeah, the level, the direction, it affects borrowing costs, investment valuations, inflation, everything. And there are several key rates we often hear about. Usually the order from lowest to highest goes something like federal funds rate,
And the discount rate.
the call rate charged by brokers.
And then the prime rate that banks charge their best customers. Each tells you something different.
Okay, let's pivot a bit. We've talked macroeconomy. How about individual stocks? How do professionals categorize them? Besides just industry, I mean.
Right. They often group stocks based on how they react to the economy or their size or their growth prospects.
Okay, so let's start with cyclical stocks. Sounds like they follow the business cycle, right?
Exactly. Their performance really tends to parallel the overall economy. When times are good, they boom. When the economy contracts, they tend to suffer more.
So we're talking about industries like machine tools, construction, autos.
Yeah, basic materials like steel, rubber, cement too. Companies whose fortunes are closely tied to big economic shifts in spending patterns.
It's a classic trap, though, right? Investors often pile into these after they've already had a big run, near the peak.
That's the danger. Understanding the cycle helps you ideally buy them when they're out of favor, maybe near the trough, anticipating the recovery.
So the opposite would be defensive stocks.
Correct. These are much less sensitive to the business cycle. Demand for their products or services stays relatively stable, even in a recession.
Because people still need, what, electricity? Food?
Exactly. Utilities, food companies, tobacco, alcohol, pharmaceuticals, maybe cosmetics, necessities or near necessities. People tend to buy them regardless of the economic climate, so they can offer stability when the market's volatile.
Okay. Then there are growth stocks. These are the high flyers, often.
Typically, yeah. These are companies whose sales and earnings are growing significantly faster than the overall economy. They usually reinvest most of their profits back into the business to fuel that growth.
Which means they often pay very small dividends, or none at all.
Right. So the appeal isn't income, it's the potential for the stock price itself to appreciate significantly over time capital gains.
They tend to be riskier, though. Higher potential reward, but higher risk.
Generally, yes, because a lot of their value is based on future expectations. If that growth doesn't materialize, the stock price can fall sharply.
And analysts often look at things like the price-to-earnings ratio or PE ratio for these stocks.
They do. Growth stocks often have high PE ratios because investors are willing to pay a premium today for that expected future growth. The PE is just the market price per share divided by the earnings per share, or EPS.
So if a stock trades at $180 and its EPS is $10, the PE is 18.
Correct. And they also tend to have low dividend payout ratios. That's the annual dividend per share divided by the EPS. If that same company paid a $2 dividend,
$2 divided by $10 EPS is a 20% payout ratio, meaning they reinvested the other 80%.
exactly, reinvesting for future growth.
Now, what about the flip side? Value stocks.
Right. These are stocks that appear to be trading at a low price relative to their fundamental value. Things like their earnings, their assets, their dividend yield. They seem cheap or undervalued.
So they might have low PE ratios or high dividend yields?
Often, yes. Value investors are looking for a bargain, essentially. They're betting the market has overlooked or unfairly punished the stock.
What's the risk there? That it's cheap for a reason.
That's the main risk. Maybe the company really does have problems and the stock isn't going to recover. It could be a value trap.
Yeah.
Value investing often means being contrarian, buying what's unpopular.
Okay. Another big classification is market capitalization. Market cap. What's that about?
It's basically just the total market value of a company's outstanding common stock.
How do you calculate it?
Simple. Multiply the current market price per share by the total number of shares outstanding.
So if ADDCo has 10 million shares outstanding and the stock is trading at $25.
Their market cap is $250 million. And outstanding means shares held by the public, not treasury shares the company bought back.
And we categorize companies based on this. Large cap, mid cap.
Yeah, there are general brackets, though they're not super strict definitions. Large cap is typically over $10 billion. Think major established companies. Mid cap might be $2 billion to $10 billion. Small cap could be $300 million up to $2 billion.
And then even smaller.
Right. Micro cap might be $50 million, $300 million, and nano cap below $50 million.
And why does this matter to an investor? Is it just size?
Size often correlates with risk and growth potential. Small caps are usually newer, maybe less established companies. They can be more volatile.
But potentially offer higher growth if they succeed.
That's the idea. Micro and nano caps are generally considered very volatile and risky, suitable only for investors with a high risk tolerance. And remember, these boundaries shift as company values change.
Okay, so we've got the economy's pulse, the cycles, how stocks behave, but who's actually trying to, steer the ship? That brings us to government and central banks, right?
Exactly. Monetary and fiscal policy. The two main levers used to try and influence the economy. There are different economic schools of thought on how effective these are or how they should be used.
Let's start with fiscal policy. That's the government side.
Right. This comes from Keynesian theory, largely. The idea that government intervention through its own spending and taxing powers is needed to manage the economy, smooth out the business cycle.
So who makes these decisions?
The president and Congress. They control the federal budget.
And how do they use it? Like in a recession?
In a recession, Keynesian theory suggests the government should increase spending maybe on infrastructure, unemployment benefits, or cut taxes. The goal is to put more money into people's pockets and businesses' hands to boost demand and stimulate activity.
And if the economy is growing too fast, maybe causing inflation.
Then fiscal policy might move the other way. Reduce government spending or increase taxes to cool things down, reduce demand. Of course, these decisions can also be influenced by political goals, not just pure economics.
Okay, so that's fiscal policy. What about monetary policy?
This is the domain of the central bank in the U.S., that's the Federal Reserve, or the Fed. Monetary theory focuses more on controlling the money supply and the availability of credit to influence interest rates and economic activity.
And the Fed is designed to be independent from politics, right? Theoretically.
Theoretically, yes. To make decisions based on economic data, primarily focused on its dual mandate, maximizing employment and maintaining stable prices, which usually means keeping inflation low and predictable.
So how does the Fed approach this? What are the main stances?
Broadly, they can adopt an easy money policy or a tight money policy.
Easy money means making money easier to get, lowering rates.
Exactly. The Fed increases the money supply, which tends to push interest rates down. This encourages borrowing and spending, aiming to stimulate economic growth.
And tight money is the opposite, to fight inflation.
Right. The Fed reduces the money supply or slows its growth, which tends to push interest rates up. This discourages borrowing and spending, aiming to slow down an overheating economy and curb inflation.
And you mentioned this affects yield curves. How so?
Yeah, typically an easy money policy leads to a normal upward-sloping yield curve. Short-term interest rates are lower than long-term rates. People expect growth and maybe some inflation down the road. But a tight money policy can sometimes flatten or even invert the yield curve, where short-term rates become higher than long-term rates. That's often seen as a signal of economic trouble ahead, possibly a recession.
And when we say money supply, what exactly are we measuring?
The Fed tracks different measures. The main ones are M1 and M2. M1 is the narrowest, most liquid measure. It includes physical cash, checking account deposits, things you can spend immediately. M2 is broader. It includes everything in M1, plus savings accounts, money market accounts, small CDs, things that are easily converted to spendable money. The Fed watches how these are growing.
Okay, so how does the Fed actually control the money supply and interest rates? What are their tools?
They have several tools in their kit.
Hmm.
The one that has potentially the biggest structural impact, though it's used less frequently, is changing reserve requirements.
That's how much cash banks have to keep on hand.
Essentially, yes. Banks have to hold a certain percentage of their customer deposits in reserve. They can't lend it all out if the Fed lowers that requirement.
Banks have more money available to lend out.
Precisely. That increases the money supply, potentially lowers interest rates. Raising the requirement does the opposite, forces banks to hold more, lend less, tightening money. This has a powerful multiplier effect, too.
The multiplier effect.
Yeah, when a bank lends money, it often ends up deposited in another bank, which can then lend out a portion of that, and so on. A small change in reserves can lead to a much larger change in the overall money supply.
Interesting. Okay, what other tool?
A key one is the discount window. This is where the Fed acts as a lender of last resort to commercial banks.
So the Fed lends directly to banks.
Yes, and the interest rate it charges on these loans is the discount rate. If the Fed lowers the discount rate, it makes it cheaper for banks to borrow reserves, encouraging lending and easing money. Raising it has the opposite effect.
And changes to this rate are seen as a strong signal.
Very much so. It signals the Fed's policy direction. And importantly, the discount rate is the only rate directly set by the Fed board itself.
Okay. Then there's the federal funds rate, which we mentioned earlier. The Fed doesn't directly set that one.
No, the Fed funds rate is the rate banks charge each other for overnight loans of reserves. It's determined by supply and demand between banks.
But the Fed targets it, right?
Exactly. The Fed uses its other tools, primarily open market operations, to influence the supply reserves in the banking system to push the actual Fed funds rate towards its target level. It's a key benchmark for short-term rates.
Which brings us to open market operations. You said this is the main tool.
Yes, this is the Fed's most effective, frequently used, and flexible tool. It's conducted by the Federal Open Market Committee, the FOMC.
And this involves buying and selling government bonds.
U.S. government securities, yeah. Treasury bills, notes, bonds. They do this in the secondary market with large dealers.
So if the Fed buys securities...
When the Fed buys securities, it pays for them by crediting the reserve accounts of the seller's banks. This injects money into the banking system. More reserves mean banks can lend more, which eases the money supply and tends to lower interest rates.
But potentially inflationary if they do too much.
Correct. And if the Fed sells securities.
Then money flows out of the banking system to pay the Fed, reduces reserves, banks have less to lend, tightens money supply, rates tend to go up.
Exactly. This helps curb inflation. Because it's done through buying and selling, it's easily adjustable. They could do a little or a lot and reverse course quickly if needed.
They also use things like repos and reverse repos. What are those?
They're essentially short-term versions of open market operations. A repo, or repurchase agreement, is when the Fed buys securities from a dealer with an agreement to sell them back shortly after, maybe overnight, like a temporary injection of reserves easing money short term. A reverse repo is the opposite. The Fed sells securities with an agreement to buy them back. This temporarily drains reserves, tightening money short term. They use these for fine-tuning.
Okay. Are there any other tools?
Well, the Fed also sets margin requirements for buying securities on credit regulations T and U. Raising margin requirements means investors have to put down more cash, reducing borrowing, and thus tightening credit in the stock market. It's less broad than other tools, though.
And finally, sometimes you hear about moral suasion or jawboning.
Yeah, that's basically the Fed trying to influence bank behavior through public statements or nudges from bank examiners, trying to persuade banks to lend more or less. Its effectiveness is debatable, pretty limited compared to the other tools.
So, summing up the Fed, any tool that adds money or makes it easier to borrow tends to be inflationary, while tools that remove money or make borrowing harder tend to be deflationary, or at least disinflationary.
That's the core idea, yes.
Yeah.
They're constantly trying to balance growth and inflation using these instruments.
Okay, let's widen the lens one last time. We're not in a vacuum. International economic factors matter too, right? Like exchange rates.
Absolutely. We touched on how U.S. interest rates affect the dollar if U.S. rates go up relative to other countries.
Foreign investors want those higher returns, so they buy dollars to invest here.
Right. That increased demand for dollars pushes up its value. The exchange rate strengthens. This is based on the spot rate, the current price for exchanging currencies right now. Yeah. Lower U.S. rates tend to weaken the dollar.
And this ties into the balance of payments, trade deficits, and surpluses.
It does. A trade surplus means a country exports more than it imports. A trade deficit, like the U.S. often has, means imports exceed exports.
How does the exchange rate affect that?
Well, a weaker dollar can actually help reduce a trade deficit. It makes U.S. goods cheaper for foreigners to buy, boosting exports, and it makes imported goods more expensive for Americans, potentially reducing imports.
So U.S. exporters like a weaker dollar?
Generally, yes. While U.S. importers and consumers buying imported goods prefer a stronger dollar because it makes those imports cheaper. It's a constant tension.
Okay, fascinating stuff. We've gone from the big picture economy down to the nitty-gritty of central banking and global trade. But for investors, it also comes down to individual companies.
Exactly. Macroeconomics sets the stage, but you also need to understand the specific company. That's where fundamental analysis and looking at financial statements comes in.
Right. The two main ones being the balance sheet and the income statement. Let's start with the balance sheet. You called it a snapshot.
Yeah, it shows a company's financial position, what it owns, what it owes, and its net worth at a specific point in time, like December 31st.
And the core equation is always assets, liabilities, plus stockholders' equity.
Always balances. Assets what the company owns. Things like cash, accounts receivable, money owed to the company, inventory. Those are current assets, usually usable within a year. Then you have fixed assets like buildings, equipment, and intangible assets like patents or goodwill from acquisitions.
Liabilities are what the company owes. Current liabilities are debts due within a year, like accounts payable, money the company owes suppliers, taxes payable. Long-term liabilities are debts due further out, like bonds or long-term bank loans.
And stockholders' equity is the residual interest. It's the owner's stake, the value of the stock issued, plus retained earnings, profits reinvested over time, and maybe capital surplus, money raised above the stock's par value. It's the company's net worth.
Okay, so balance sheet is a snapshot. What about the income statement?
That shows performance over a period of time like a quarter or a full year, also called the P&L, profit and loss statement.
It starts with revenues or sales, right?
Right at the top. Then you subtract expenses, cost of goods sold, operating expenses like salaries, rent, marketing, and also depreciation, which is a non-cash expense reflecting the wearing out of assets.
What's left after operating expenses is operating income or EBIT earnings before interest and taxes.
Exactly. And analysts often look at EBITDA too, earnings before interest, taxes, depreciation, and amortization. Because D&A are non-cash charges, EBITDA is sometimes used as a rough proxy for cash flow from operations.
And from EBIT or EBITDA, you can calculate profitability ratios, like operating profit margin, or see how well earnings cover interest payments.
Precisely. Things like operating margin, operating income divided by sales, show efficiency. And bond coverage ratios, like EBIT divided by interest expense, show the ability to meet debt payments, Crucial stuff for understanding a company's health.
Wow. Okay. We've covered a huge amount of ground here, from the macro pulse down to the micro details of a company's books.
We have. It really shows how interconnected everything is, doesn't it?
It really does. So what does all this mean for you listening right now? It means this world of finance. It isn't some impenetrable black box. It's a dynamic system, and, you can learn to read the signals.
That's the key takeaway, I think.
Hmm.
Understanding these forces, inflation, interest rates, the business cycle, how policies work, how companies perform, it empowers you. This raises an important question. How will you use this deeper understanding to interpret the headlines and make more informed decisions?
Yeah. Next time you hear about inflation ticking up or the Fed changing interest rates, or maybe even just read a company's earnings report, think about those ripples. How might this affect different industries, different types of stocks or bonds? What stands out to you about how these pieces influence your own choices, your own financial landscape?
Keep asking those questions.
Exactly. Keep that curiosity alive. Keep exploring this complex, sometimes confusing, but ultimately really rewarding world of economics and finance.